In the world of investing, many novice investors grapple with an essential question. Should I consistently invest for the long haul or wait for that elusive moment when the market dips? This dilemma pits dollar cost averaging against the strategy of buying the dip. In today's video, we'll explore both approaches, analyze real-world examples, and discuss insights from well-known studies. We'll also delve into the psychological factors that lead investors astray and how to steer clear of common pitfalls, where our mission is to make investing concepts accessible. Remember, this video serves for educational purposes only and is not financial advice. Let's jump in. First, let's break down dollar cost averaging, or DCA. This investment strategy involves committing a fixed amount of money at regular intervals, be it weekly or monthly, regardless of market fluctuations. For instance, you might invest $500 on the first of every month into an index fund, no matter the market is soaring or struggling. DCA effectively removes the emotional highs and lows associated with investing. You aren't trying to guess the perfect landing spot. Instead, you remain consistent. The beauty of the name dollar cost averaging lies in its principle. When prices are elevated, your $500 yields fewer shares. When prices plummet, you accumulate more shares. It's not about timing the market. It's about having time in the market. This strategy is particularly beneficial for individuals with steady incomes who wish to gradually build wealth. It instills discipline, alleviates stress related to market timing, and helps you avoid the procrastination often seen in investing. The benefits of DCA: mitigating market volatility. By investing consistently, you spread your risk over time. The investment is less affected by short-term market fluctuations. Building investment habits. Regular contributions can instill a disciplined financial habit, encouraging long-term thinking about wealth accumulation. Psychological advantages. DCA helps you detach emotionally from your investments. The roller coaster of market emotions often clouds judgment. DCA removes this pressure, allowing you to stay the course. Buying the dip. Now, let's contrast that with buying the dip, a strategy where investors hold off on committing funds until a market correction occurs. The theory is simple: purchase when prices are low. After all, who doesn't appreciate a good deal? However, the challenge lies in defining what constitutes a dip. Is it a 5% drop, or does it require a 10% threshold? What if the market continues to fall? This strategy assumes you can recognize a temporary decline and react accordingly, a task far easier said than done, even for seasoned professionals. Historically, markets have trended upwards, so waiting for the perfect moment can lead to missed opportunities. Additionally, market timing is notoriously difficult. Even professional investors struggle with it. Let's uncover the pitfalls of this strategy. The risks of buying the dip. Fear of missing out, FOMO in volatile markets. Emotions can drive irrational decisions. Investors may buy too soon, falling victim to further price drops. Opportunity cost. By holding on to cash while waiting for a drop, investors may miss out on significant gains. As the market continues to climb, those who wait for a dip may find themselves left behind. Modeling success. Many investors look at the few success stories of dip buyers, but these instances are not the norm. Understanding average market performance through the lens of historical data is essential to avoid the pitfalls of selective memory. A fictional example. Let's illustrate both strategies with a fictional scenario involving two investors, Alex and Jordan. Each begins with $6,000 to invest over a year. Alex opts for dollar cost averaging, investing $500 at the start of each month, totaling 12 contributions. Jordan, however, decides to wait and buy the dip, keeping his cash reserves until the market experiences a correction of at least 10%. In our fictional year, the market faces a downer in the first quarter, dropping 8%. Jordan, anticipating further declines, holds on to his cash. Meanwhile, positive economic indicators spur a swift market rebound, leaving Jordan frustrated as his capital remains idle. Contrarily, Alex continues to invest consistently, purchasing more shares at lower prices and fewer when the market rises. By year's end, Alex captures the average growth throughout the year, showcasing the power of consistency. Timely investing at market lows is notoriously challenging. If Jordan enters too late, he loses out on potential gains. Conversely, an early entry without adequate cushioning can leave him unable to average down. Insights from Charles Schwab. To better understand these strategies, let's examine an enlightening study from Charles Schwab. Over a 20-year period from 2003 to 2022, they tracked 5 hypothetical investors, each employing distinct investment strategies with annual contributions of $2,000 into the S&P 500. Peter Perfect, the dream investor, perfectly timing the market every year, amassed over $138,000. Ashley Action, investing on the first trading day of each year, she earned around $127,000, just $10,500 short of Peter. Matthew Monthly, he employed dollar-cost averaging, dividing his $2,000 into 12 monthly contributions, resulting in over $124,000, remarkably close to Ashley's total. Rosie Rotten, despite her poor timing at yearly peaks, she ended up with $121,000, a testament to simply being invested. Larry Linger, the procrastinator who waited endlessly for an ideal moment, ended with just $44,130. While lump sum investing often yields the best results due to prolonged market exposure, dollar-cost averaging secured third place, showcasing potential through consistent contributions. Buffett's wisdom. Warren Buffett, one of the most renowned investors, advocates for a steady investment approach. He advises that for most people, the smartest decision is to invest consistently in a low-cost index fund and forget about market timing. His philosophy emphasizes the importance of patience and discipline, echoing the core principles of dollar-cost averaging. When you invest for the long term, you allow compound interest to work in your favor, a powerful ally in wealth building. Ultimately, it's critical to understand that this decision isn't binary. Adopting a dollar-cost averaging strategy doesn't preclude you from capitalizing on market dips. Many long-term investors maintain a DCA approach while keeping a reserve of cash for strategic investments during downturns. DCA aligns with human psychology. It alleviates decision-making anxiety and lessens the emotional toll of trying to predict market movements. Legendary investor Warren Buffett emphasizes the importance of a consistent investment strategy when he advises that the stock market is designed to transfer money from the active to the patient. Your mindset is as crucial as your strategy. If you found this video helpful, please give us a thumbs up and consider subscribing for more insightful investing content. We'd love to hear about your experiences. Have you tried buying a dip? Or how is your dollar-cost averaging journey going? If you enjoyed this video, you might like this one too. Thank you for watching, and we'll see you soon.